The banks are like, come on, we know you want a better banking system, but can't we just keep making a lot of money for now? Wouldn't that be nice? They are funding institutional businesses with lower interest rates than they should be paying by stealing from retail. And they don't want you to know this. It's one of many contributors to our K-shaped economy where those with assets are getting richer and richer and those without are getting poorer and poorer. They put your money at risk in various loans and duration mismatches and all this kind of stuff. You should get compensated for that. There's the risk-free rate, which is putting it into a T-bill. So today that's 4%. But when you put your money at the bank, they give you 0%. Why do they do this? Because they're subsidizing big business.
Hello and welcome to the Bitcoin Magazine podcast. I'm your host, Spencer Nichols, and today we sit down with the one and only Mike Belshe, CEO, CTO, and co-founder of BitGo. Mike and BitGo operate at the epicenter of the institutional adoption of digital assets, and Mike shares his inside baseball on what institutional investors are thinking of Bitcoin in the current market climate. Mike also discusses the fight between the banking and digital asset industries over the Clarity Act and why tokenization of equities he believes could cement the future of the US as a true leader in capital markets for the decades ahead. Thank you as always for tuning in, and let's get into it. Hello and welcome to the Bitcoin Magazine podcast. My name is Spencer Nichols, and I am sitting down now with Mike Belshe, the co-founder, CEO, and CTO of BitGo. Mike, welcome to the show. How are you doing today?
Hey, Spencer, great to see you. Thanks for having me on.
Of course, absolutely. I guess first things first, recently we had the Bitcoin for Corporations Symposium in New York City. You yourself were there speaking on stage with Dylan LeClaire. Just kind of want your take on what the vibes were like there. I think we've gone through a pretty aggressive bout of volatility in the digital asset treasury space. What were your takeaways from that event, and how was it overall?
Well, it was a great event. Thanks for your guys' participation, helping, I think, indirectly organize it, or I'm not sure exactly, but it's a good crowd. Look, I mean, actually, the thing I like most about the Bitcoin dominant, I wouldn't say it was quite specific, but pretty close to Bitcoin specific. The folks that are in there, especially have been around for quite some time. I think you don't have to worry about like their ethos as much. Like they're in it for the right reasons. So anyway, a lot of really good people there that are in it because they see the long-term potential and value of Bitcoin. So everybody's kind of scratching your head when you're in that space right now, thinking like, look, we know that there's real issues with the US dollar. We know that Bitcoin can be used as a global settlement system in a way that we've never had the ability to do before. And yet, Bitcoin is not trading super great right now. And there's a lot of questions. So I think there's two things that are on people's minds. Number one is quantum. And whether you believe that's an issue or not, that's not my point. There's a lot of people that are worried about that. And then the second thing that people are looking at least for the short term, is they don't really understand what Michael Saylor's products are, how they work. And they hear leverage. And look, leverage, obviously a lot of bad things can happen when you're over levered. They don't know whether MicroStrategy, strategy, and Saylor are over levered or not. They don't understand the basics of it, but they are confused by it. So I think those two things are kind of leaving everybody befuddled as to why Bitcoin isn't performing a little bit better right now. And of course, we got AI out there. So all right, anyway, the vibes of the conference are very nice. A great group of people. And then we go through ups and downs a bit, and I think everybody there is pretty patient.
Yeah, I think, like you said, a lot of people are very long-term oriented, and they also understand the long-term thesis of Bitcoin as this neutral settlement layer between, adversarial counterparties, trust minimization, and all the way down the line. But I think to get us from Bitcoin as this rather speculative commodity where it's being used in, bits and pieces to that effect, but really to get us there, it's how do we plug people into the network in a way that scales? And BitGo is sitting right at the intersection of that. Basically providing the picks and shovels for kind of the digital transformation of our capital markets. I guess, right now, obviously a bit of a down market, but what are those conversations you're having, in behind closed doors with folks on the institutional capital side? Is there genuine interest that's still at play? Have you felt kind of those conversations cooling as, sentiment follows price? What are those like right now? And, in the context of this bear market?
Part of the reason I got into Bitcoin in particular, and it's the first time I ever got into anything even close to finance. I spent my entire career, so I'm a technologist by background. I spent all my time doing software engineering and technology. I had friends in college that went off to work in finance. For me, I've always felt finance is kind of just a bit of a scam. There's these people that produce nothing. They take an oversized bite for like giving you advice on how to invest and allegedly help you make more money. And yet, if you look at them, it's not even on average, they aren't that good. It's like the vast majority of them are not that good. And so, you look at funds, I think about three-quarters of them are always underperforming the S&P. What kind of a career do you have if the best you could do is run a fund that couldn't even beat the S&P? All right. I think finance is riddled with these people. So there it is. I'm a little bit off track from your question. You were asking what is it that's holding back institutions? So the institutions don't really understand what Bitcoin is. They'll invest in anything. They'll invest in meat pies. They'll invest in crypto. They'll invest in AI. They'll invest in whatever they think is going to make money. And frankly, they don't really have as much insight as they'd like you to believe that they do. All right. Nonetheless, the girl in the red dress is absolutely AI. She is enamored all of them, and they're only focused on that right now. When they think about Bitcoin a little bit, they're like, they never really understood it. And they're like, well, it doesn't look like it's doing much right now. But I mentioned quantum already, right? Like they're really worried about quantum. They don't get quantum either. That's this crazy complex technical topic. You have to go read a lot of papers in order to understand where quantum might be on a timeline, what impact it might have, et cetera. So, look, I think we do have to address this. I think, as much as I complain about others, look, we are here because we'd like to see Bitcoin proceed further and faster. And part of what you have to do in order to get people to work with you is to demonstrate and convince them that whatever their fears may be, there are good solutions, they're addressed, et cetera. So I think the good news is that like the Bitcoin core team, a number of initiatives are all moving much faster than they were a year ago to address this problem. I think we should get a quantum resistant signature inside of the Bitcoin core protocol ASAP. And as soon as we do that, I think we'll unlock a lot more institutional
Hmm.
interest again.
And you think quantum really is like a key sticking point as like kind of the primary blocker for these people, or is it really
Yeah.
just a momentum kind of psychology aspect too?
I think it's actually real. So when we were doing our roadshow for BitGo going onto the public markets just in January this year, I mean, I was surprised. I'm expecting to get questions about BitGo and how we're performing. Of course, we did get those, but a top three question all the way through was what's going on with quantum computing? What's going on with quantum computing? So it's a real concern that they have. And think about it this way, right? You're going to run a fund and you're going to have billions of dollars in it. And imagine if one day billions of dollars is gone. And remember, they also, what I just said, they don't really understand anything about the products that they invest in. So when they hear this quantum computing threat, they don't know what to make of it. And it is so new that it's kind of an outside thing. And there's not very many risks that are just like, hey, that's a risk that could completely take all of my capital. So anyway, it's an unusual thing, and they're more concerned about it than they should be. Now, for the record, just so everybody here that's listening, I personally don't think quantum is a significant threat on the near term. It doesn't matter what I think. What matters is what the world thinks. And if the world thinks it's an issue, we should just address it. We're getting close to being able to do it. I have zero doubt that the Bitcoin community will come through and come up with quantum resistant algorithm. They will then have enough time to get it into wallets. BitGo will absolutely lead that, just like we did. We were the first to put a Taproot transaction on chain years ago, adopting both Taproot and Schnorr. We designed the UTXO spending algorithm that's inside of Bitcoin Core today. And we will continue to be Bitcoin forward. Of course, we pioneered multi-sig as well, which you absolutely should be using if you're using Bitcoin. So anyway, we'll be there. The industry will be there. I think that the core devs would absolutely come together if there was ever a need to scramble, but I don't think we're going to need it. Nonetheless, let's make sure that nobody has to worry about
Mhm. And so we've seen perhaps quantum fears and also just sentiment, I think, just really slow down kind of uptake of Bitcoin by those kind of net new participants, particularly on the institutional side. They've kind of not yet, the thundering herd has not yet quite arrived. But I think that something that really has been continuing apace is the stablecoin side of the equation. And we've seen just like many institutions coming out and saying stablecoins are something they're actively exploring, actively implementing. There really doesn't seem to be kind of any headwinds on that front. And also, Clarity is front and center right now, potentially heading to the Senate for a vote here shortly. I think a lot of market watchers are watching that with bated breath. Poly market, whipsawing up and down on the odds. But could you just give us a snapshot into really where we're at with stablecoin adoption now and how you see that growing? I know BitGo operates really at the juncture of how these institutions are bringing stablecoins into their operations, but what is the momentum like on there? And then I think I'd like to get further down on that on why are stablecoins so important to our financial system, but really like what is the temperature check for that uptake currently?
Well, if we just talked about how quantum can really inhibit the adoption of a Bitcoin, they don't quite understand it, all this. The good thing about stablecoins, they're really easy to understand, right? So first you had to kind of understand that there's this blockchain primitive, which allows you to kind of move this value around seamlessly very quickly. But then the idea of a one-to-one correlation between the stablecoin and the dollar, that's super easy to understand. So Genius Act, of course, was passed last year already. It was not only easy for people to understand from a how it works perspective, but it was also pretty easy for legislators to understand how they might regulate it. Okay, we're going to have a token. We're going to verify that there's a backing of at least this type of asset behind it. Turns out we've had this for a long time. It's called a reserve bank. That's what BitGo does. We are a OCC chartered national bank. We are not a depository bank, which is the type of bank that takes risks and needs to buy extra insurance to cover those risks. Instead, we just hold your assets and you have them all the time. So the good news, stablecoins fits the bill for how do you make something that people can conceptually understand and not have to like say, I don't get this, I can't adopt this. So that's good. And everybody sees the potential. Frankly, there's been a pent-up demand prior to crypto for something like a stablecoin. This is evidenced by we've had a myriad of different payment fintechs over the last few decades that shouldn't have existed if the banking system worked that well. So if banks did a great job of payments, which we used to write checks, right? Then we kind of eventually moved on to credit cards, sort of banking, a little bit different, but people use it for payments all the time. Largest source of payments, I guess, to this day. Debit cards, ACH. Then you end up with like PayPal, Venmo, Cash App. Down the line, there's all of these payment apps. Why do these payment apps exist if banks are making payments great? Well, they failed. They don't make it easy. It takes them a long time to move. They kind of get stuck on regulatory. I'm not trying to blame them alone. They have been heaped with a very high regulatory burden, which makes it difficult for them to roll out new products. There's a little bit of kind of innovator's dilemma. Once you are the incumbent, you have all this, innovative team with this new idea. You're like, I don't know if it's going to work or not. And so instead, PayPal does it, right? It turns out to be an interesting thing. So good news, stable coins, there's a lot of pent-up demand for them. And then I think when you really start talking about a global economy and a global financial system to go along with it, this is where the banks kind of got stuck. And it's probably mostly due to regulatory. So every jurisdiction, whether it's the US, whether it's China, whether it's Europe, whether it's the UK, it has its own controls on money. And everybody decides differently. And of course, every government wants to control its money. This is, natural. I'm not complaining good or bad here. It is. So what's happened prior to having stable coins is that we never solved the problem. And moving money internationally is hard to this day. Western Union charges exorbitant fees to people that want to move money globally and has done for a long time. Stablecoins finally disintermediate that. You can move money super easy. It's $1. People get it. So, I think you probably are familiar with this story, but we had a zero interest rate environment just a few years ago. And, Tether was operating all through that, by the way. Kudos to them. They weren't making a lot of money in a zero interest rate environment. But then as the U.S. started to increase rates again, kind of right after the COVID period, all of a sudden, what happens? Well, that causes the U.S. dollar to get stronger against all of the other currencies around the globe. And of course, the U.S. is already a pretty strong currency. It is the reserve currency of the world, even now, despite all of its flaws. But for some of the more brittle, more fragile currencies, they start to inflate. just a little bit of drop in strength and they go kind of crazy. So this happened in Turkey in droves. And what happens is the poor people of the country that is losing control of its money, and it's always losing control of money. Just go back to Milton Friedman. He'll tell you very clearly it's one reason and one reason and only. It's government overspend every single time. But what happens to the poor people is that, look, their value, like all of their hard-earned savings is disappearing in front of them. They have to do something. And what did they turn to? They didn't turn to Bitcoin. They turned to Tether. They turned to Tether because it's conceptually easier to understand. It's not that they had anything against Bitcoin. They probably had heard of it. They didn't understand it, right? But this is a digital dollar. I can get it. I need something that gets off of my currency. I can get to the dollar. I can save my family. Very simple, like existential problem that they have to solve, and so they do. All right, so stablecoins are clearly here. Now, what's good about stablecoins is that people get it conceptually. We're getting stuff in place legislatively. That'll come down to regulation. Companies like BitGo as an OCC national bank, we can absolutely provide you a genius compliance mechanism today. We're doing that for the USD1. That was our first one that we did. It's now we're a little under 5 billion in size right now. We're doing that with SoFi. So if you want to use a fully, it's a top 50 bank here in the US. I think it's top 50-ish. But a major public company, financial bank, you can do it through them. They use BitGo behind the scenes. United Stables recently moved over to us. We've got, I think, a half dozen others that are doing as well. Now, the bad news, Genius doesn't allow for interest on your stablecoin. Okay. So look, as with any regulatory capture, the guy that's got the regulatory capture doesn't want to let go very, very easily. He's benefiting from it. And the banks are like, come on, we know you want a better banking system, but can't we just keep making a lot of money for now? Wouldn't that be nice? All right, look, eventually the banks are going to have to give it up. Like, stable coins are a better way to save and hold deposits. You should get interest. It's your money. You deserve it. And the idea that the government's going to come in and tell you can't get your own hard-earned money, the risk-free rate, is insane. As much as I'm excited about stablecoins, I do think it's a massive change to payments. It's not completely done either. We still need more innovation. I'll give you a couple of examples. Most of the payment stablecoins run on Ethereum. If you want to run small transactions, the Ethereum fees are simply too high. Like, you want to run a $10 transaction, but paying a $1 ETH fee doesn't work. Doesn't make sense. So can't do it there. So you're like, okay, maybe I'll move to Tron. Maybe I'll move to Solana. Maybe I'll move to something else. And, there's definitely places where you can get lower fees. But remember, if those coins go up in value, if those get more traffic, they're also going to have a fee-related issue. But more importantly, there's a second thing, which comes back to ease of use. And this is, if I could give the crypto industry one thing to think about, focusing on for the next couple of years, ease of use, making the concept of whatever it is good. So if you finally manage to get your grandmother to agree that she should accept, she should pay you in stable coins or whatever, it should be like, okay, I get it. It's one stable coin. It's $1. No problem. And then she's going to try to move it. And it's going to be like, it said I didn't have enough to pay the gas fee. And it's because it needs an ETH fee or a Solana fee or a Tron fee or whatever fee. All right, look, these aren't really plumbed through universally yet. And, there's some solutions. So Stripe, along with Paradigm, created a blockchain called Tempo. It allows you to pay fees in kind of the stablecoin. It's early days. They're kind of, I would say, on the nascent side, but they're up and coming. They're trying to solve it. Circle's got its own blockchain called Arc. Same thing. Both of these guys who are doing lots of payments realize you can't have this world where you're trying to move dollars and yet you have to have some other foreign currency in order to move it. It doesn't make any sense. So I imagine you went to Burger King and you're buying your $10 burger and they say, okay, it'll be $10 plus, 0.3 euros, please. Nobody wants to do that, right? It's just painful. So anyway, we got to fix those two problems. We got to fix the fee problem so that it's not, a variable tied to the chain going to rates that are too high. And number two, probably more importantly, we got to make the usability so that you don't have to pay in the native coin. So this is being addressed now. It's the first time it's really started to be addressed, and that's due to people finally kind of getting their heads around what's the opportunity with stablecoin.
Yeah, and I think like where there's this opportunity, there's going to be a lot of disruption, and there's kind of been this underlying tension with this adoption of stablecoins is what does this do to the traditional banking model? What does this do to the incumbents that are, kind of rent seeking, not necessarily innovating? What has that tension been like that you've seen between, say, the traditional banking industry and the digital asset space? I think people like to frame it as somewhat contentious, especially the fight over yield. But what has your read been on like that? And do you anticipate that it will be a transformation of the existing system or really just a disruption of it from the outside?
I hope we see a full transformation. Um, when it comes down to regulatory things, it's not a fair playing field. So a lot of different outcomes could be possible. Senator Elizabeth Warren published a piece and accused the OCC of granting companies, including BitGo, trust charters inappropriately, and it's going to like make the banking system unsafe. Okay, well, in her letter, by the way, she didn't say anything about how that would actually come to be. And then from our side at BitGo, we very much think not only is she wrong, she's completely opposite wrong. Like what BitGo does as a national trust bank is a reserve bank. It's actually the bank you wish you had, but you never had. Pre-computers, it wasn't really realistic to have a reserve bank like what we do. Instead, you were using a traditional bank, a depository bank. And these guys take risks with your money. And from time to time, they screw up. It's happened over the last 120 years. And when it happens, it can be spectacular. The most recent banks that failed were SVB and Signature Bank. But you probably remember Washington Mutual and many, many others that have failed over the last few decades. And when they do fail, every single time it leads to some new regulations, some new laws being passed. And all of these laws are well intended, of course. They are designed to help protect against that type of failure happening again. Unfortunately, I think when you have a demand deposit bank, which lends out money, there's no set of rules or regulations which will ever drop the risk to zero. It just can't happen. And so it's worthy of note of what is a demand deposit bank, a depository bank. What it means is that you, as a client of the bank, can come in and you can make a deposit today. And then tomorrow you can come and demand that money back and they have to give it to you. So imagine you walked into a bank that just opened the day before and you're the first account holder and you're going to deposit $1 million and you deposit your $1 million. All right, great. The bank's happy. You're happy. Your money is safe. It's in this brand new shiny bank. And then what's the bank do? Well, the bank's going to go take your $1 million and they're going to lend out 80% of it, maybe 90% of it, to somebody in a perfectly good loan, and they're going to pay it back, I don't know, in 2 years, whatever. And then if you show up at the bank the next day and you say, well, I want my $1 million back, they're going to be like, we
Wait
lent
a
it
couple of
out.
years. Yeah.
Okay, so this is safety and soundness. Obviously, the banks are not allowed to do the scenario I just described. They're required to have policies and rules and whatnot around how they will make sure that you'll be able to always get your $1 million back, and yet they lend it out so that they make money and keep the whole thing safe and et cetera. Well, look, bankers have proven over and over again, they're not very good at this. I criticize the finance industry. I'll give you one real quick. The Silicon Valley Bank, look, it's run by financial professionals. And these really great, smart, intelligent men decided in the middle of a zero interest rate environment that the best way for them to make money, because they wanted to get a little return, was to take the depositors' money and put it into 10-year T-bills. And they would make like 1.8, something like 1.8%. That was their best idea. So they're supposed to be financial professionals. And yet their best idea for what to do with your hard-earned money was to put it in a 10-year T-bill. Okay, well, I'd argue you can probably put it in a 10-year T-bill yourself if that's what you wanted. And then you get to keep the full 1.8% to yourself. But moreover, like, really, that's all you could do? And then secondarily, they didn't think like, hey, this is a zero interest rate environment. Maybe if the interest rates go up above 1.8%, our clients might want their money back to go put into something that'll earn more than 1.8%. And of course, the bank went under as a result. So this is why I say these financial institution professionals, they're not always the sharpest tools in the shed, and yet they're heralded to be able to steward billions of dollars of money. All right, well, we create regulations to help prevent these types of things from happening. It makes it very difficult for these businesses, whether they're well run or not, to do a lot of innovative things. And we now have banks that can't keep up with payments. And that's why you have what we just talked about, all of those apps that wouldn't exist. if the banks were doing their job. So yes, I hope we can get a revolution. And I guess if you want me to finish that thought, I rambled too much here. The depository bank has two functions, right? Helps the retail guy keep their money safe, deposited, hopefully gives them a little bit of interest, and then lends out that money to businesses to help make the economy go around, to provide liquidity in the world. And those two things are coupled, right? So you take depositor money and you lend it out. It used to be you had to run that way because we didn't have computers. But these days we have computers. And so actually there's no reason these two things have to be coupled. You can have like one place where you save your money and a different place where you go and you lend and borrow money. Mm-hmm. And the idea that these things are coupled is just historical. Now the banks are clinging to that because that's their business model. And by the way, there's one other thing which has happened historically, which is why they're clinging to it. And that is that they are funding institutional businesses with lower interest rates than they should be paying by stealing from retail. And they don't want you to know this. It's one of many contributors to our K-shaped economy where those with assets are getting richer and richer and those without are getting poorer and poorer. And what I'm talking about here is you go to the bank and we just talk and we just demonstrate they put your money at risk in various loans and duration mismatches and all this kind of stuff. You should get compensated for that. They are taking a risk with your money. There's the risk-free rate, which is putting it into a T-bill. It's the economic definition of a rate of return without taking any risk, because a T-bill is perfectly good cash and it's fully backed by the full faith and credit of the United States government, who prints the dollars, and they can always print more dollars. So it's fully backed. It really is zero risk. And so today that's 4%. But when you put your money at the bank, they give you 0% or 0.1%, which is so close to zero, let's call it zero. Why? Why do they do this? Because they're subsidizing big business. And so you have to remember, by having coupled these two things together, something happened. They've got depositors. The bank has two jobs. One, collect depositors. And number two, find borrowers. Those are the two jobs. All right, so they collect the depositors and they say, okay, this guy should get the risk-free rate, maybe a little bit more. We should give him 5%, right? And then the bank wants to take a little fee. Maybe the bank wants to take 5% so it can run its operation. Probably fair. And then in order to lend it out, they have to lend it out at 10%. Over time, businesses that want to borrow large amounts of money are the best clients that the bank tries to go find on the lending side. And, somebody's borrowing $100 million. And so that's a big client to the bank. And that guy says, hey, Mr. Bank, you're charging me 10%. I only want to pay 9%. This is too expensive. If you can't give me 9%, I'm going to go to the other bank. And the bank scratches their head and they say, gee, but we have to pay the depositor 5 and we need 5. What do? Do we take that 1% from ourselves or do we take it from the retail depositor? Well, the retail depositor has no power, so they take it from him. And what's happened is over time, because we don't have that many banks, and by the way, counter to Liz Warren saying we shouldn't have new banks like BitGo, in the 2010s, there were like 0 new banks created in the US, like 0, like literally 0. And all right, so the bank decides to take from the depositor. And over time, over the last couple of decades, this is just whittled down and whittled down and whittled down. And the incumbent banks are effectively like an oligopoly. They've all done this together so that they're all charging roughly the same interest rate. And it's all about 0. And what they've done is they've subsidized that $100 million loan to the big business guy on the back of retail. They love this business. Big business loves this business. They don't want to change.
The regulators as well. The regulators need those tax receipts to keep flowing. I mean, I feel like this is reminiscent of both like these people that they're lending to are too big to fail. The government is kind of regulating them, but also funded by each of these parties. It feels like the same exact moral hazard that takes place within the Federal Reserve is also taking place in how, these incumbent banks are pulling the ladder up behind themselves and seeing that competition can't enter the arena. Would you say that's a fair, I guess, analogy to what we're seeing out there in the banking industry?
I think these things all come together. Yeah, I think even just looking at kind of that business model, I try to simplify it down. I know I'm oversimplifying, right? But you try to simplify it down to just the basic functions: depositors, lenders, borrowers, and it's kind of easy for people to understand. You throw in the other things, which is like, well, oh, that guy's going to now use his profits to go kind of make sure he can get a cheap loan. Yeah, he's probably going to do that. So look, I think there's a better model. I think blockchains are what deliver it. Stablecoins are what deliver it. And the new model is this. You take the stable coins and you use those as your deposits, and that's for retail. You always give them at least the risk-free rate. They get their full 4 or 5%, whatever the number is, and they do it at zero risk. It's the risk-free rate. They get the risk-free rate. They pay a little bit for the banking and security, but this is measured in basis points instead of percentage points. Now the lending market. So the banks will tell you, but we need that money because otherwise we won't have liquidity in the market. You won't be able to get a small business loan. Like everything's gonna fall apart. I call BS on this also. First off, the market is very efficient and has a great way of solving these problems. I think absolutely the big business can afford a couple of percent extra. It might cause his loan price to go up, but that might mean there's a little bit less borrowing. But I think the market absolutely can absorb it. And there's even a couple of historical examples that show that it can. But secondarily, I think we create a marketplace for loans, which is better anyway. So now imagine instead you have a lending marketplace, and borrowers can line up to borrow, and lenders can line up to lend, and you can get it from private equity. Corporates can lend, high net worths can lend, retail can lend. Whoever wants to lend, it's just a marketplace. Create a lending marketplace. We have computers that can do this stuff. We no longer need a bank that couples deposits from retail with borrowing, lending to anyone, and creates this unnecessary risk. So I'll give you one last thing, which might get you more excited on the political side, since you sort of mentioned some of that. Once regulation comes into play, I don't think you can ever get rid of it. It just never goes away. It's a bureaucracy. It kind of lives on itself. So when I complain about safety and soundness of a bank, I don't think there's any way to change all the regulations that are applied to a depository type bank. I think they're there for good. So how do you make a lighter weight regulatory environment? And by the way, I'm not trying to make it less safe. I want to make it more safe. I think what happens, and this is where innovation is amazing. Innovation comes in, gives us a new model, and we then look at that model, we evaluate it, we look at the risk of that model. That's where Elizabeth Warren is completely wrong. The new model is you take a reserve bank, like what BitGo does, not taking any risk with your money, and you regulate that differently. It doesn't need the full safety and soundness of a traditional bank because it doesn't do any of the lending, none, right? By the way, she sometimes says these guys aren't even insured, and she's talking about FDIC, Federal Deposit Insurance Corporation. We're not eligible for the insurance because we don't take on-demand deposits. All right, so the innovation can shift the model. We separate out the deposit part to be stablecoin based, risk-free rate, no risk being taken. The lending part, we get a better lending market anyway. And now we get the side benefit of having reduced regulatory oversight, which makes the whole thing more efficient.
So, Mike, you made a really compelling case for both the economics of innovation there, where there is just essentially a lower risk, more efficient system that can take place. Yet you also describe kind of this regulatory capture that will stymie that innovation. I think it's going to be really interesting to see how both of these forces play out. Really, the big tailwind is you have the incentive structure for the macro side, where stable coins backed by U.S. Treasuries are extremely beneficial to those issuing U.S. Treasuries, essentially generating that captive demand in emerging markets. Could you offer any words on just like what you see that potential becoming in the future? I think right now, like obviously the stable coin market has ballooned somewhat, but it's nowhere near where it needs to be kind of like one of the primary buyers of U.S. Treasuries. I think people projected getting there, but do you see that continuing to be an important force on the macro side as well?
Well, let's see. You asked two different questions there. Will it be an important force on the macro side? To some degree, yes. I think actually you bring a bunch of people into the U.S. economics that otherwise wouldn't be there. I think we will see collapse of some of the weaker foreign currencies will just fold into dollars. You're probably familiar with El Salvador runs on the dollar today, right? Others run on dollar-backed currencies today. So this would be sort of like doing that again. Now, then lastly, will it just keep growing? No, I don't think so. So I think what happens is a little bit different. Instead, what happens is the liquidity on-off ramps between stable coins and other types of products continues to grow. And remember, the number of companies that are offering stablecoin on-off ramps like BitGo is very small. It's measured in either hundreds or maybe low thousands, right? Whereas eventually everybody's going to support them, and there's going to be lots of ins and outs. And so, look, payments are money moving, right? You've got your savings, you've got your assets, the stuff you put to work. Tremendous amounts of value sits completely outside of the currency system. Instead, you store the value in assets, right? So there's some amount of payments that are kind of always in float, and those will obviously exist. But the digital rails are going to be even more fluid than the traditional rails because they run 24 hours a day, because everybody can support it. It seamlessly goes between custody and not custody. It goes between the US and the world instantly. Banks don't have these features, none of those features. So banks have kind of an impediment, which keeps more in the payment system than probably needs to be there. But I don't think we should be scared of this. Like, this is actually just all good news.
Yeah, and I think that also leads into the conversation I know BitGo is very deeply involved in is around the tokenization of equities. I think like if you could speak to that, it would be great. Just where are we at this point in time? But really also I want to dig into like what are the implications of the tokenization of equities? Yes, we could trade them 24/7, 365, but does that change the structure of markets generally? I think that's where a lot of people are looking is, when we globalize access to US capital markets, what does that do to the nature of US capital markets? What does it do to the nature of global volatility? I just think these are like outstanding questions that we can't answer until we get there. But I think yourself being right at where this is taking place could offer some insights.
Yeah, actually, I feel really lucky where BitGo is. I mean, obviously you kind of, establish a viewpoint from where you sit, but look, our OCC chartered national bank is a really powerful entity, both on the banking side, how we just described about reserve banks and what can be done there that never could be done before, but then also on the tokenized equity side. And remember, so BitGo has the same standing as DTC, which is Depository Trust Company, not related to Depository Bank, but Depository Trust Company is the ultimate holder of all street name uh, equities in the US, actually in the world. So about 85% of all equities sit over there. And then I don't know, something like 99.8%. I won't have that number right, but it's pretty close to that of traded stocks go through there. So we have the same standing that they do. And now the difference here on stablecoins versus tokenized equity, there was lots of discussion of, not just discussion, there are implementations of stablecoins going all the way back to, I think, 2015, maybe when Tether started. I'm not entirely sure. But this has been growing for quite some time. The tokenized equities were really completely on the sidelines until 18 months ago. And that is the former administration and, Gary Gensler of the SEC was simply unwilling to have any conversation about how to bring digital and equities together. I met with Paul Atkins actually last week. Everybody says the same thing. Like, he's such a refreshing conversation. And you can be pro crypto digital assets, you can be anti. The conversation with him is always great. He wants to do a few things. He wants to make it so that the US capital markets are the best capital markets in the world. I don't know anyone that disagrees with that. He recognizes that we need to have more IPOs. We need to have more companies choosing to go public. The fact that all these companies were kind of stuck in private land is a sign that we have not been keeping up globally, as the best capital market. Now, don't get me wrong, the US is far and away the best capital markets. But if you keep that trend, it's the wrong trend for the country. It's the wrong trend for our economy. Oh, that's good. And then the third thing where he's just really refreshing is that he's like, look, there's going to be new technology and we need to have the ability to innovate. So he is very, very open to having safe harbor for innovation so that things can happen. And it's not just you're going to get thrown in jail because you tried something that you thought would be great and didn't work out. Of course, you still got a lot of restrictions on equities. You have to trade them through broker dealers. They have to trade on ATSs and exchanges. But, can you have some new inroads and tests that you're doing digitally? And then it's not just crypto firms that are doing it. The DTCC, which is the owner of the DTC, is doing it directly. They got no action letter from the SEC. That's all public. So they are aggressively moving into this. Of course, all of the asset managers there, BlackRock, Fidelity, Wisdom Tree, Morgan Stanley now. On the broker side, of course, Morgan Stanley again. You've got Charles Schwab, Citi, like all of these guys are very excited about what's possible. And look, the crypto market in total is a little less than 2 trillion right now, I think. The equities market is like 70 trillion in size. So it really opens up the field for what can be done. And, the big change is that we finally have a regulatory scheme where we can at least start to experiment. And not only are we experimenting, we're experimenting with the guys that have been doing this forever. So it's really good news. It's exciting. I do think we're going to be able to see massive change here as well. And actually, the Reserve Bank, I think, again, turns out to be a critical piece for working in that field.
Yeah, and as we see this adoption of tokenization, where do you see this going? I mean, I think from the user experience, it's pretty clear. Hey, I can trade and move these assets at any time, anywhere. But I also think that again, it raises a question of what does this do to markets? Is this something that the SEC is looking at as far as trying to keep markets liquid, trying to stem off any types of, like, say, contagion risks? Are these conversations that people are having, or are you more in kind of the early stages of implementation and kind of the risk side is, I think, yet to be fully understood or fleshed out?
No, these conversations are happening right now. Look, actually, if you take the anti-digital side for equities, I think you would say a couple things. You'd say, look, the U.S. capital markets are great. They're incredibly efficient, which is true. You can trade at almost no cost through Schwab, right? You can do like trades for 5 cents, right? I mean, it's really, really low, and these guys still make money. So they're like, why do we need digital? Like, is it really going to be any better? And when it comes to just if spot trading, that might actually be mostly fair. So I think there's a couple of things that open up. One is potentially transparency. I'm going to come back to the potentially word in a second. The second one is lending against securities. So just like you can borrow against your Bitcoin, shouldn't you be able to borrow against your securities? The traditional guys might say, "Oh, but you can already." No, no, no. If you go to Schwab, or any of these brokers, sure, they'll give you a margin account, which is letting you borrow against your equities so that you can do one thing: buy more equities.
Yep.
They don't let you take the money out to pay for your kids' college, things like that. Some people can, of course. It does vary depending on who you are, but for large number of accounts, of course, you can do that. So lending, I think, is one that opens up. And then the third one, I'm just going to label as innovation. I'll leave a hint here. At BitGo, we have a bunch of ideas around where innovation can come. We haven't launched it yet, so I don't quite want to talk about it. But on the innovation side, the traditional guys will be like, well, what innovation am I going to get? Well, isn't that the beauty of innovation, right? You have to create an innovative environment to see what you could get. They might say, well, why don't the original guys do it? Well, look, you need fresh blood. It's the same reason why, the youth become the adults. Everything cycles in life. And yes, we need innovation to bring in new ideas. And I would predict 90% of the new ideas will be terrible. And there will 10% which will be okay. And there'll be like a couple that'll be so awesome. We'll be really glad that we digitized all the equities. But that's the way innovation is, and it always has been. So this isn't like a crypto related thing. Now back to the potential transparency. The reason I said potential, in the blockchain space, we've said for years that blockchains provide better transparency than traditional markets. It's true, but we haven't really added privacy into most of our coins yet. And then you can see where one place where the traditional world is going is Canton Network. Really one of the first networks to enable privacy. The traditional firms like it because they get a permissioned ledger, so they have more control over it, and then it's also got some privacy. Interestingly, the same regulators that a couple years ago to all of us trying to do retail products, they said, no privacy to retail. You guys are doing bad stuff, money laundering, bad. But then when the corporations do it, they say, oh yeah, of course you need privacy. Yeah, you can't trade without privacy. So wait, which one is it? Anytime you see one privilege being extended to institutions, businesses, whatever, and not being extended to retail, there's something wrong, right? So of course, retail needs to have privacy. Once we have privacy, you won't have quite as much transparency, but you'll still have mathematical proof. And mathematical proof is incredibly important. The GameStop guys will tell you that, there was a heck of a lot of shorting there. It looks like somebody was doing naked shorting. Has it happened? If you move to a pure blockchain system, it will be mathematically impossible to do. So anyway, I think there'll be a bunch of benefits that we get from it. A lot of them we won't be able to see until it comes. But look, every single traditional firm is also seeing the excitement of upgrading their systems to something more modern, reducing the number of errors, increasing the speed. Crypto already deserves credit for making 24/7 markets, even in traditional. They are copying because of Bitcoin, because of crypto. So that's a win that should be claimed by digital assets. Anyway, there's more to come.
Yeah, and the final question I want to ask, I think, is it's becoming clear that there's again this like appeal to um, a permissioned network, something that I think these institutional players feel comfortable around, very heavily regulated, and then there's kind of the cypherpunk Bitcoin style, permissionless, anyone anywhere can do anything at any time type of network. Do you see Bitcoin meaningfully capturing any type of this tokenization or stablecoin activity, or do you see this more existing on permissioned networks that these kind of regulators are more comfortable with allowing their regulated participants to use rather than pushing them towards something like shifting that activity towards Bitcoin?
Well, I don't like the either or that you gave me there. So let me just split that into two parts. First, you've got kind of open networks versus closed networks, and like when you've got permissioned ledgers, that's a closed network. Um, I think they always lose to open networks in the end. Maybe regulatory capture helps them stay alive a little longer. I don't know, but ultimately, an open network will be better. And it's very simple. Like the best markets are the markets that bring the largest collection of buyers and the largest collection of sellers. And an open market, by definition, will do that more than a closed market. Regulation could play in. Well, second thing, when it comes to money, there's going to be regulation. There's going to be rules around it. It's not going to be open, complete cypherpunk, like you said, where it's just like everybody can do everything. So this is just going to exist. Whether it should or not, I almost don't even want to say. I probably lean more libertarian than not, but I don't think it matters. I think that when it comes to money, most Americans actually do expect some amount of safety and control. Without it, you get things like FTX, right? So, and we in the crypto space certainly can't deny that there's been some pretty colossal, ugly failures when you have purely no rules. So, I think we definitely need rules. There will be some. I think that we will have open networks that abide by those rules. I hope that we end up with regulations that allow us to continue to have those open networks. Because if we can make sure that the money flows freely at as many places as possible, that'll be a win. I'll give you a quick example on this. You know, there's a lot of competition between the U.S. and China. Um, Obviously, China is a massive country. They outnumber America in terms of population by about 4-1, I think. Um, the economy is booming. They've got tremendous manufacturing capabilities. They will be the largest GDP in just a couple of years here, and nobody questions this. But will they be a place of global capital markets? No, not for a very long time. So they have severe capital controls, which is the flow of money. It's a closed system. It's not an open system. We've seen, of course, that when companies get too big for their britches, Ant Group and whatnot, the government will step in and just declare it gone. Foreign ownership is extremely limited. If you want to have an open network, an open money system, it's got to be open to as many people as possible. I think the U.S. should kind of rethink its policy here. I think this is an issue for us. Under the Biden administration, they decided that the sanctions controls on Russia should be implemented, and we should just take their, I forget what it was, 300 billion or something like that. Look, whether you're pro-Russia, Ukraine, that's not my point. We have the US dollar is the world's reserve currency, which is a different thing. It's not political, it's a money. And if you want to have the world's reserve currency, you can't go snatch it away from people that you don't like. So there's lots of countries that are, allies of the US, and yet they do things which Americans sometimes don't like. And if they worry that America's can just steal their money because they did something bad, like maybe they killed a reporter in their land, heard that before. And if you were afraid of having all your money taken away because of the US political thing, that wouldn't be very good. So again, this is really just open systems versus closed systems, right? The closed system allows you to take the money away. The open system allows everyone to participate. So anyway, everybody needs to be aware of that if you want to win.
Understood. Yeah, I think in right now in geopolitics and macro, is that conversation is being had repeatedly with Iran responding to kind of the Strait of Hormuz and saying, hey, you can pay us in Bitcoin. We know we can receive that, no problem. And so, yeah, that macro story and kind of the open versus closed nature of these systems is like that's, in my opinion, one of the most
It,
important transformations that we'll be seeing
it,
on the nation state front.
it is true, and this is where stablecoins don't cut it. So Iran learned a frustrating lesson. They had their tether confiscated, and of course, the government didn't have to go take the tether coins, took the underlying, right? So went to Tether and said, "Hey, give us Iran's money," and of course, Tether did. I'm not criticizing Tether here in any way. Any U.S. regulated company would have done the same thing. So stablecoins don't have that sovereignty that Bitcoin does. Now, some people might, Elizabeth Warren probably would say, "Oh, that's a bad thing. Stablecoin's good and Bitcoin bad." Look, if we are going to have multiple governments, multiple countries, which I believe we will, I hope we do, each one of these countries has its own things that it wants to do, its own culture, its own people, its own rules, and that's okay. And we don't trust each other, and we shouldn't trust each other. And stable coins from one country aren't going to make it for global settlements. It's going to have to be something where, like, the other guy can't rug pull you, and of course, Bitcoin provides that, but the stable coins don't.
Absolutely. Well said. Well, Mike, I think that's all the time we have for today, but really appreciate you sharing your insights here. And thank you to our audience on the Bitcoin Magazine podcast for following along. Mike, do you have any parting words for our audience before we wrap up here?
Look, thanks for doing the show. Everybody, keep your chin up during the bear market. Been through this 4 or 5 times. I don't know when at this point. It always comes through. It seems dark when you're in it, but this is just part of the process as we grow. And there's so much more to be learned, so much more innovation to be had. We are definitely on the path to a better financial system.
Excellent. Well said. Well, everyone, we'll see you on the next one. And Mike, have a great rest of your day. Thank you.